Many researchers contribute to a retirement account every month without knowing what investments they actually own. They know money is leaving their paycheck. They know it is going into a retirement account. But if asked what that money is invested in, many would not know the answer. Understanding the investments inside your retirement account is one of the most important steps in becoming a confident long-term investor. In this video, we'll discuss the most common investments found in retirement accounts, how to recognize them, and what you should pay attention to when reviewing your own portfolio. In the previous video, we discussed retirement accounts. A retirement account is not an investment. It is a container. The investments live inside that container. Think of it this way. If someone says they have a 403b or a 401k, that tells you where the investments are held. It does not tell you what investments they own. Two researchers could both have a 403b account and have completely different portfolios. One could be invested primarily in stocks. Another could be invested primarily in bonds. A third could be invested in a target date fund. The account is the container. The investments inside the account determine how the portfolio behaves. If you log into your retirement account today, there is a good chance you will encounter one or more of the following: index funds, mutual funds, bond funds, and target date funds. Let's briefly discuss each of them. Index funds are among the most common investments used by long-term investors. Their goal is simple. Instead of trying to select a handful of winning companies, an index fund attempts to track a market index. For example, an index fund might track the S&P 500, the total US stock market, or international stock markets. When you purchase shares of an index fund, you are effectively buying small pieces of many companies at once. This provides diversification and reduces dependence on the performance of any single company. Many retirement plans include low-cost index funds because they offer broad market exposure and are relatively simple to understand. If you remember only one thing from this section, remember this: an index fund is not trying to beat the market. It is trying to follow the market. The term mutual fund often causes confusion. Many people think index funds and mutual funds are completely different investments. In reality, they describe different things. A mutual fund is a structure that pools money from many investors and invests that money according to a specific strategy. Some mutual funds actively select investments, others simply track an index. This means that many index funds are also mutual funds. When reviewing your retirement account, you will often see mutual funds listed by name. The important question is not whether a fund is a mutual fund. The important question is what investment strategy the fund follows. Bond funds work differently from stock funds. When investors buy stocks, they purchase ownership in companies. When investors buy bonds, they are effectively lending money to governments, corporations, or other institutions. Bond funds combine many bonds into a single investment. Historically, bond funds have often provided lower expected returns than stock funds, but they have also tended to experience smaller fluctuations in value. Because of this, bonds are frequently used to reduce portfolio volatility and manage risk. Most retirement portfolios contain at least some bond exposure, particularly as investors approach retirement. If you work at a university, there is a good chance that your retirement account contains a target date fund. These funds are often identified by a year. For example, Target Retirement 2050, Target Retirement 2060, or Target Retirement 2065. A target date fund is designed to automatically adjust its investment mix over time. When retirement is far away, the fund typically emphasizes growth-oriented investments such as stocks. As retirement approaches, the fund gradually shifts toward more conservative investments such as bonds. For many investors, target date funds provide a simple, hands-off approach to retirement investing. Whether they are appropriate depends on individual circumstances, but it is important to understand what they are and how they work. One detail that is often overlooked is cost. Every investment fund has expenses associated with managing and operating the fund. These costs are typically expressed as an expense ratio. At first glance, the difference between a low-cost fund and a higher-cost fund may appear small. However, investing is a long-term activity. Even relatively small annual fees can reduce portfolio growth over several decades. This is one reason many investors pay close attention to investment costs when evaluating funds. Fees are not the only factor that matters, but they are one of the few factors investors can directly observe and compare. Another topic that often causes confusion is financial advice. Many retirement plan providers offer educational resources, planning tools, and consultations at little or no additional cost. These services can be extremely useful, particularly for people who are still learning about investing. Some providers also offer managed portfolio services. These services may use factors such as age, expected retirement date, risk tolerance, and third-party research to recommend or adjust investment allocations. For many investors, this level of guidance is more than sufficient. There are also fully personalized financial advisory services. These may include detailed financial planning, portfolio management, tax planning, and ongoing consultations. Such services can be valuable in some situations, but often involve additional fees. The key point is not that one approach is always better than another. The key point is to understand what services are available, what they cost, and what level of guidance you actually need. Before paying for investment management, make sure you understand the resources already available through your retirement plan provider. This week, log into your retirement account. Find out, what investments do you own? Are you invested in an index fund, bond fund, target date fund, or something else? What are the expense ratios? Are there educational resources available through your retirement plan provider? You do not need to make changes immediately. The goal is simply to understand what you own. Knowledge often comes before action, and understanding your investments is one of the most important steps toward becoming a more confident investor. In the next video, we'll discuss brokerage accounts. We'll explore how they differ from retirement accounts, when they might be useful, and how they fit into a long-term investing strategy. Thanks for watching, and I'll see you in the next video.